Hey, it's Tom here and welcome back to the channel. So in this video, I want to talk through the topic of buying the best businesses versus buying the best investments because I find that a lot of particularly newer investors tend to think that just buying the best quality businesses in the stock market, the one that has the highest return on equity and they have the highest growth rate and they require fairly modest amounts of capital to continue growing out into the future. A lot of investors tend to think that buying those types of companies tend to promise the best returns, and that is in fact not the case. And that's a topic that I actually covered with Tobias Carlisle a couple of weeks ago here on the channel. Now, Toby Carlisle basically talked us through two different sort of quantitative styles of investing. The first one being Joel Greenblatt's magic formula, and the second one being the acquirer's multiple. Now, one of the interesting things that you find when you compare these two strategies is basically the magic formula has two components when it tries to find businesses to invest in. So it essentially has one component which looks at the return on capital, which is sort of a proxy for business quality, and the second one is it has an earnings yield, which is a proxy for valuation, and it sort of combines and ranks businesses on each of those two categories and then gives them an overall score and ranking and invests in sort of the most highly ranked businesses in that basket. Now, if you actually look under the hood of the magic formula like Tobias Carlisle has done and test some of the different factors involved in driving good returns, because the magic formula does have a very, very good track record, a market-beating track record, you actually find that all of the returns and more are explained by the valuation factor within the magic formula. So in other words, the return on capital or the business quality metric is in fact detracting from the returns that you would have got by just purely investing on the companies that were the cheapest and had the highest earnings yield. So that's something that I found really fascinating. Intuitively, I sort of think that buying the best businesses surely would be pretty good investments, but it turns out that that is not the case. And that's a topic I want to dive into for the rest of this video. So if you do enjoy it, please hit like and hit subscribe. But for now, let's get straight into it. Now, there are a couple of fundamental reasons why just buying the best businesses does not necessarily promise the best results. And as much as I kind of hate to put investing in the stock market in sort of a gambling context, I think that this analogy works quite well, so I'll run with it anyway. Now, you basically have to think of the stock market as sort of a parimutuel betting system. So a betting system like you might find at a horse racing event or a boxing event, where sure, you have all of these different horses or athletes, or depending on what sport you're going to, all these different competitors in a particular sport, and you might be able to very easily identify which is the most skillful and most likely to win. If you went to bet on the Floyd Mayweather versus Logan Paul fight, you probably would have found it quite obvious that Floyd Mayweather was the strong favorite. But that doesn't necessarily mean that betting on the best horse is going to offer the best return, because of course each of those different horses or different boxers, if you're looking at a boxing match, have very, very different odds. So in the Floyd Mayweather versus Logan Paul fight, for example, if you wanted to make $100 return on putting some money on that fight, and you wanted to put money on Floyd Mayweather, you would have to put an enormous amount of money on Floyd Mayweather to get your $100 return, and you could put a much smaller amount on Logan Paul to get the same return, assuming that you thought Logan Paul was going to win. So it's not always about betting on the best athlete or the best horse or the best company in stock market terms. It's about weighing up the odds of each of those companies as well as the actual business prospects. And in terms of weighing up the odds, that basically comes down to price, just like the magic formula tries to consider, and just like Toby Carlisle's acquirer's multiple basically only considers price. And that basically means that if you look at a really high quality company, oftentimes they offer fairly poor returns moving forward because everyone knows it's a really good company and therefore it has a really high price attached to it. And anytime that you pay a really high price for a company, that underlying business needs to perform extremely well in order to offer you a good return. So we know that the intrinsic value of any business is the present value of its future cash flows. So you look at all the cash that it is likely to produce between now and when it eventually, stops doing business, whether that's 10 years or 50 years or 100 years or 200 years out into the future, and you discount those cash flows back to today in order to come up with some sort of value. And when you have to stack that value up against the price you pay, that basically means the higher the price you pay, the more cash that business has to earn and then distribute over its lifetime. So that's often what you find with some of these really high quality businesses, is that they'll have high prices attached to them, and it means that basically the bar in terms of how much cash it has to distribute to you over a period of time is higher than a company in which you have to pay a lower price for. And of course, buying into some of these really good businesses has worked, and there's countless examples of that. You've got Amazon, Monster Energy, Costco, Berkshire Hathaway, of course. But many of those businesses were, at least at one time, available at reasonable prices. There's not a whole lot of businesses in there. Perhaps Amazon is an exception to that, where people are paying very, very high prices several years ago and still get a very good return. Amazon has been a bit of an exception to that, but Amazon's business has just done so well that it's even more than justified paying 50 or 100 times earnings a few years ago to buy into that business. So it's about stacking up the odds, not only buying the best businesses, but also paying a reasonable price for them and factoring in the odds that you're also going to get a return that is really good if the business does perform well. Now, one of the other things that often comes into play here is a concept called mean reversion. And again, this is a topic that Toby Carlisle has written extensively about. And in a business context, at least, mean reversion is basically the idea that a business earning really high profit margins or returns on capital eventually, over a period of time, sort of comes back to a more normal range of margins and returns on capital. And also, on the other side of the spectrum, businesses that tend to be earning a very low return on capital or low margins tend to, as a group at least, come back to earning more reasonable margins over time. And that basically means that if you are to buy into one of these very high quality businesses, it's likely that mean reversion is probably going to be working against you. Other companies are going to see this business earning very high rates of return on its invested capital or on its equity. They're going to see it earning very high margins, and that basically is almost like an invitation for competitors to come in and try and disrupt that business. And we only have to think back to Warren Buffett's presentation at this year's Berkshire Hathaway annual meeting to see that he put up these couple of slides of the biggest and best companies in the 1980s versus the biggest and best companies in the stock market today, and there was literally zero overlap in the top companies on each of those lists. So we know that capitalism is very brutal. We know that companies are always fighting this, disruption that will eventually come for many of them. And that means that when you do really pay up for one of these businesses, you need to be very, very confident that it has something protecting it from all this outside competition. And that is why Warren Buffett and Charlie Munger, for example, talk so much about moats and competitive advantage. You need to find one of these rare businesses that basically doesn't mean revert, that doesn't have its margins shrink over time. You need to find a company that, for whatever reason, people just come back and keep buying its products and won't even consider its competitors because the product is so good, and that allows it to keep earning these high rates of return on capital and on equity and good margins. Apple is a fantastic example of that, where they've continued to earn very, very high rates of return. Even though there are a lot of competitors out there, they have this very loyal fan base, and they've built up this ecosystem which kind of keeps people using Apple products and so on. Whereas if you took something like a commodity company, for example, commodity companies are notorious for going through these very wild swings in profitability, and they're a very prime candidate for mean reversion, and mean reversion happening very quickly oftentimes. So they can earn super normal profits when commodity prices are very high, but eventually when commodity prices are very high, everyone else in that industry turns on production or ramps up production, and that inevitably brings commodity prices back down to earth, or even very, very low, and then people have to reduce production, and it's kind of just this never-ending cycle of wild ups and downs in commodity markets. So what does this actually mean for the everyday investor in the stock market? Well, I think it means a couple of things. Firstly, if you want to buy into a really high quality business, you have to pay attention to the price. You can't just bet on the best horse. You have to also understand the odds that horse is offering in this particular, capitalist race to the top. So that is the first thing to consider. You do genuinely have to understand the odds that have been offered to you as an investor and stack those up against the business quality. And if you do end up paying up for a business, you have to understand whether or not that business has any sort of competitive advantage. And that competitive advantage has to be truly durable. It has to be something that can last a very, very long period of time. The Apples of the world, the Coca-Colas of the world are great examples of companies that have been able to keep competition away because their products are just so good. Yet you have car companies and things that get disrupted all the time and, have market share stolen back and forth, and it's kind of a race to the bottom in terms of pricing because people can just go to the next car yard and buy a pretty similar product for cheaper prices. And there's a lot of really kind of tough competition that goes on in an industry like automotives that really can be a bit of a race to the bottom, and you sort of end up with all of these companies that are earning quite poor margins. So those are a couple of things that you have to watch out for: is do the odds make sense at the current price, and do they have some sort of competitive advantage that will kind of keep mean reversion from happening to that particular company. Now, the other thing that I find kind of interesting is a bit of a thought experiment, and actually something that I have done from time to time in my portfolio, is actually kind of flipping this on its head and looking at what happens if we buy low quality companies. What happens if we bet on the worst possible horse out there, or one of the worst horses out there, but that particular horse offers phenomenal odds if it does work out. Now, I don't really mean that in a gambling context where you're betting on things that are likely to go to zero and might come back. But every now and then you can find a business where the odds are priced in a way where it thinks that the earnings are going to drop off substantially, or it thinks that the company might go bankrupt, or people just really do not want to own that business for whatever reason. But when you look at the underlying business, you actually find that it is surprisingly high quality, or it has a surprisingly large amount of assets kind of under the hood in that business. So that's really what we're searching for. It's not necessarily about buying the best horse or the worst horse. It's about buying the one with the best odds, not necessarily buying the best company or the worst company, but buying the best investments, and obviously trying to steer clear of the worst investments. So to sum this whole thing up, yes, buying good businesses can be a very good strategy, but you have to consider price, and if you purely just buy the best businesses, it's probably actually not going to work out that well. On the other side of things, quantitatively at least, if you use a Toby Carlisle acquires multiple type strategy, you can actually just buy a basket of some of the worst businesses and actually have a pretty good track record. And if you look a little bit deeper and potentially look at a basket of businesses that have very, very good odds should they work out really well, people are kind of kicking those businesses to the curb, and if you can find companies that are actually much better than the odds suggest, you can find really good investment opportunities. And it's basically all about trying to find this misalignment between the quality of the business and the odds that are being offered by the market. So I do hope you enjoyed the video. If you did, please hit like and hit subscribe. But that's it from me, and I will see you in the next one. Cheers.